If you want to invest without having to read balance sheets, listen to earnings calls, look at PE ratios, and much, much more, then ETF investing is right for you. So an ETF, or an exchange traded fund, is like a basket of different investments such as stocks, bonds, or real estate that you can buy and sell on a stock exchange, similar to how you would trade an individual stock. So when you buy an ETF, you're investing in a collection of assets which help spread out your risk. For example, an ETF that tracks the S&P 500 includes 500 of the largest US companies. ETFs generally have lower fees compared to mutual funds because they are passively managed, since they follow an index rather than having a team of people making active decisions. ETFs can also be bought and sold throughout a trading day, unlike mutual funds which can only be traded at the end of the day. Now there are many types of ETFs, and the first is stock ETFs. So this is when you invest in a group of stocks that often track an index like the S&P 500. So bond ETFs would obviously be focused on providing steady income, doesn't have much risk. Now sector ETFs target specific industries in the stock market. For example, if you wanted to invest in the technology sector, then you could buy shares of a technology ETF. So these would include a variety of tech companies like Apple, Google, and Microsoft. So this way, if one company doesn't perform well, the success of others will help balance it out. Another ETF is commodity ETFs. These just invest in physical commodities like gold or oil, and then international ETFs give exposure to foreign markets. The first ETF to buy is SPLG. So this is SPDR's S&P 500 ETF. So this tracks the S&P 500. So this includes 500 of the largest US companies by market cap. So this means when you invest in SPLG, you're getting a little piece of some of the biggest names in the market like Apple, Microsoft, Amazon, and Google. It's a great way to get broad exposure to the US stock market with only a single investment. Now there's been many studies on the S&P 500, and it's outperformed 99% of actively managed funds over the long term. So this consistency makes SPLG a reliable choice for investors looking to invest in the growth of the US economy. Plus, SPLG has a low expense ratio at 0.02%, which means you spend $2 on every $10,000 you have invested, making it a very cost-effective option for investors. And SPLG is traded like a stock, which means you can buy and sell it throughout the trading day at market prices. So this liquidity provides flexibility, allowing you to react quickly if a black swan event ever happened and you would want to take your money out. And it's just a way to build a solid foundation for your investment portfolio because it's so broad, it has so many companies. Historically, every dip in the S&P 500 has been a buying opportunity. So whether it was COVID or the Great Financial Crisis or other downturns, the S&P 500 has always bounced back. So if you have confidence in the American economy, then SPLG is a great investment to hold. The second ETF to buy is QQQM. So this is Invesco's NASDAQ 100 ETF. So this tracks the NASDAQ 100 index. So this includes some of the world's most innovative and growing companies. Investing in QQQM gives you a way to invest into the innovation and growth potential of the tech industry without having to pick individual stocks. Now while it's tech heavy, QQQM also provides exposure to other sectors like consumer discretionary and healthcare. So this diversification will help limit risk while maintaining strong growth potential. Now you've probably heard of the ETF QQQ, or often referred to as the Qs, and QQQM is essentially the same thing. So their returns are almost identical. They hold the same companies, they are managed by the same company, and the sector allocations differ by 0.02%. So the primary difference is the expense ratio. QQQ has an expense ratio of 0.20%, while QQQM's is 0.15%, meaning you spend $15 on every $10,000 you have invested. So with a lower expense ratio than QQQM allows you to keep more of your returns. So lower fees mean more of your money is compounding over time, generating higher returns. Another distinction is that QQQ is favored by traders due to its higher liquidity, while QQQM is tailored more towards long-term investors. So for simplicity, let's use QQQ's performance as a reference since QQQM mirrors it so closely. Historically, QQQ has outperformed the S&P 500 since its inception. If we look at the year to date, the 1 month, 3 month, 1 year, and so on, QQQ consistently comes out ahead, and this consistent outperformance is driven by the growth of its tech-heavy holdings. So investing in QQQM means that you're betting on the future success of industry leaders like Apple, Microsoft, Amazon, and Meta, which have a track record of driving significant market growth. So if you want to invest in the companies driving the future of technology and innovation, then QQQM is an excellent choice. The third ETF to consider is SCHD, or the Schwab US Dividend Equity ETF. SCHD focuses on dividend-paying stocks, including companies with a strong history of paying and growing dividends. The companies included in SCHD are known for their financial stability and ability to generate profits, even during economic recessions. It's designed for investors who want steady income, along with the potential for capital appreciation. With its focus on financially strong companies and a low expense ratio at 0.06%, SCHD is a solid choice for dividend-focused investors. One of the key benefits of investing in dividend-paying stocks is the power of reinvesting your dividends. When you reinvest dividends, you use the dividends received to purchase additional shares, which in turn generates you more dividends. So over time, this can significantly boost your investment returns due to the compounding effect. This is evident with the returns of the S&P 500. The line representing reinvesting dividends significantly outperforms the line without reinvestment. Now, every investor has a different level of risk tolerance and time horizon. For younger investors, having more of their portfolio in growth-oriented ETFs like QQQM can be beneficial. Growth stocks tend to compound faster over time, and younger investors have more time to recover from potential losses. Now, for those nearing retirement, a focus on dividend-paying stocks like those in SCHD can provide a steady income stream to cover expenses. And you could always take a balanced approach and split your investments across different categories to balance your risk and reward. So this diversified approach will allow you to benefit from broad market exposure, growth, and dividend income. These ETFs offer a simple and cost-effective way to achieve your investment goals. If you found this valuable, I'd appreciate if you like or subscribe. J Money, out.